to give a presentation to employees in the community about the College Choice 529 plan and why they're a benefit. And I can tell you, I was watching the news last night and they were talking about how our college dropout rate is now increasing more than ever because people are entering college, getting their student loans, and then realizing that they're in way over their heads and they can't afford to go. So they're dropping out, which is even worse because now they have the college debt. They can't really do anything because they don't have a degree, so they're even in a worse off position. Plus, if you follow it at all, come July, they're thinking about turning back the interest rates and actually doubling the interest rate on student loans that you get from the federal government. So it's ever more important that we can prepare for the future going forward. So I'm going to turn this over to Tamika. Everyone should have a slip for the door prize, and we'll collect this at the end. Our exhibitors who are here today graciously donated some wonderful door prizes for us to get out. We're actually going to do that this afternoon after our 2 o'clock presentation at State Street, so everyone has an opportunity, and then we'll get with you if you are a winner. I think that's it. We also want to thank our exhibitors. We've got one in the room here. This is Carrie from Innovative Financial Services. We also have Markle Bank, Edward Jones, and the State Bank out front. So if you guys have any other questions or want to stop by, I think a lot of you have already stopped by some of the exhibitors, but feel free to stop by and get even more information.
Thank you. As Natalie said, my name is Tamika Easter. I'm the relationship manager for the College Choice Plan. So my job is to go out throughout the state and talk about the importance of saving for college and how the 529 plan can help you. I just want to piggyback on something that Natalie said. Does anyone happen to know what the graduation rate is in the state of Indiana? Meaning you enter college in the fall and exactly 4 years later you graduate. What's that percentage?
36.
36, she's done her homework. It's about 36, 38%. So when I do this presentation for high school seniors, look to the left, look to the right, only one of you will be the parent of a child that actually graduates in 4 years. When you kick that up to 5 and 6 years, the percentage actually goes up to 50%. So not even a huge jump in when you think about how many 5 and 6 year students we have. I think a lot of that is, as Natalie pointed out, we just don't have the finances. We get to college, we're overwhelmed. We get a scholarship, we think that covers everything. We haven't factored the road trips back and forth, the storage over the summer, feeding someone that's not in your household, and all that good stuff. So I think it's important for people to start thinking about saving for college sooner rather than later. I'm going to make a lot of references to people that have small children, but do realize the 529 plan can even be used for adults going back to school. I personally used it to complete my graduate program. When we talk to parents, we say, why aren't you saving for your kids' college education? And we get a lot of reasons. I can't afford it, I'm already living paycheck to paycheck, my kid's going to get a scholarship, and that's usually spoken by the parent of a proud 6-year-old that already knows that their child's going to get that full 4-year ride, for playing football. So we want people to start thinking about saving sooner because college costs are going up. If you have a newborn child in the state of Indiana and you want to send them to a public school in about 18 years, you're looking at about $23,000 a year for a public school and about $70,000 for a private school. That is for tuition only. That figure does not include room and board. That figure does not include books. So that's what you'd be looking to spend in about 18 years. That's why we want parents to start saving sooner rather than later. The state of Indiana has a plan. It's managed by UPromise Investments. We're the largest administrator of 529 plans in the country. I like to tell people I don't get paid a commission for whether or not you open up an account. My job is simply to go out and do workshops across the state because I'm one of those people that had student loans when I graduated and I sort of needed to know what my paycheck was going to be every Friday. So UPromise Investments, the program manager, this is the direct plan. This is the version of the plan that you can do yourself. My favorite benefit is a 20% tax credit. It's the last bullet on the page. Contributions to a college choice account are eligible for a state income tax credit of 20% up to $1,000. What does that mean to you? If you put $1,000 into the plan, 20% of that is $200. You would get a $200 credit on your Indiana state taxes. Anyone know the difference between a deduction and a credit? It's tax time, so which one's more valuable, a deduction or a credit? A credit, okay, all of you guys know that. All right, a credit, so that's gonna go on your bottom line. So in Indiana, that could be the difference between owing and breaking even when you do those Indiana state taxes. You can contribute up to $5,000 and get a $1,000 credit. That is per taxpayer. So you and your spouse, that's one $1,000 credit, not two. If you have two kids, it's not $1,000 for this kid, $1,000 for that kid. It's $1,000. That's the max. Put in $100, you still get a $20 credit. You can use the money for tuition, room and board, books, fees, and supplies at any 2-year or 4-year college or university in the country. A lot of people think it has to be used at an Indiana school. That's probably the #1 myth about 529 plans in general, that you have to use it in the state where you open up the account. That is not true. You can even use it at some schools abroad. So it's not just domestic schools. You can even use it at some schools as long as they accept federal financial aid. So if your child wants to go to culinary school, that would be a covered institution. They want to go to cosmetology school, that would be a covered institution. They want to start at Ivy Tech and then transfer out of state, that would be covered. The other benefit is that your earnings grow free from both federal and state taxes. This is most beneficial for those folks who got started sooner rather than later, because the money's going to go into your account and it's not going to be taxed, so you're not going to get a 1099 in the mail and have to pay taxes on it. So as long as you pull it out for one of those expenses, it's tax-free. What questions do you have so far on the 529 plan? Now, I'm not sure if this person is in the room, but I did get a question, can you use this in conjunction with 21st Century Scholars? As you guys know, 21st Century Scholars is a great program that if you meet the requirements, they pay for the tuition for you to go to an Indiana school. So your tuition is covered by the 21st Century Scholars Program. You can still use the 529 plan to pay for books. So you can use the two programs together. How affordable is the plan? It takes $25 to get an account open. That's your minimum contribution to open up an account. You can make contributions monthly. If you can't do it monthly, people are getting tax refunds. If you just want to drop $500 in the plan, $1,000 in the plan, you can do that, and you don't have to make additional contributions that year. So there's nothing that says you have to put in $25, $50 a month every single month to participate. But the minimum, whenever you do send us money, has to be $25. That can come out of your paycheck, it can be a check mailed in, or we can debit your bank account. Low fees, the fees range from 0.29 to 0.93% depending upon what you're invested in. So on average, if you look at some of our age-based funds, and I'll go into those, you're looking at about 0.46% in fees. So on $10,000, that's roughly $46 in fees a year. I think some banks charge that when you bounce like one check. So what are the investment options? We have two approaches. We have an age-based option that's managed by Vanguard. It automatically becomes more conservative over time because the one thing we know about the stock market is it does what? Fluctuates. It goes up and it goes down. So probably not a good time to be 100% invested in stocks if you have a 17-year-old. So with this portfolio, when your child turns 12, they're going to automatically move into the conservative growth portfolio. When they turn 15, the income portfolio. So that over time, the portfolio gets more conservative. This is the set it and forget it approach, so you don't have to say, now my kids are middle school, what should I be in? Now they're in high school, now they're going to college, what should I do? So the majority of the families choose the age-based approach. It's the simplest approach. However, if you're more conservative or more aggressive, you can build your own portfolio. So what do I mean by that? Let's say that you do not want to be in the stock market at all whatsoever. You can invest in the savings portfolio. Our savings portfolio is FDIC insured. It pays an interest rate, not much, it's 0.61% right now. But what you put in today will be available tomorrow. So if I was going back to school myself, or I had an 18-year-old, that would be a good place to park my money because I'd be using it within a relatively short period of time. We also have one U.S. equities portfolio and one international equities portfolio, and then a couple of bond portfolios as well. So you can mix and match and build your own portfolio, or you can go with the age-based portfolio. Questions on the investment options?
How long do I have to park before I can move it and still receive the tax benefit?
You mean move it out of the account?
Yeah.
So once you deposit funds, once the funds are declared in good order, you can take the money out. So when I went to graduate school, I got paid on Friday. The following Friday, I would have to mail a check to my school so that my class was paid off by the time the class ended. When you go to take your tax credit though, your account still needs to be open. So I left $10, $15 in that account so that when you promise to file over to the Department of Revenue, my account is still open and I'm still eligible for the tax credit. So the state of Indiana does not have a holding period, like some states where the funds have to remain in the account for a year, but when you go to claim the credit the following year, your account still needs to be open, and a couple of dollars will make your account still open. Other questions? Yes, sir.
Are you managing your account yourself, or
You are picking your own investment options. Yes, sir.
you can change it however you want to?
You can make changes to your, what's already invested, you can make a change to that once a year. New money coming into the account, you can change that as you put it into the account. So I'm mailing in a check and I'm enclosing new investment options, and this is where I want this check to go. But money that's already been invested, you're only allowed to switch it once per year, and that's a regulation, not that we set, but that's just set for all 529 plans. Yes, ma'am.
What if you have more than one child? Are you separate accounts? Do you one account?
That is a matter of personal preference. So I'll tell you 2 examples. If I had 5 kids and I wanted the money to come directly out of my paycheck, because I'm like a huge segment of the population, if it hits my account as free money, I'm going to spend it. But if you take it out of my check before I ever get it, I'm a great saver. So if I had 5 kids and the minimum is $25 a pay period, I might not want to do $125 every time I get paid. So I may just open out one account, put in as much money as I can, and when it was time for those other kids to go to school, I would divide up the money. So you are allowed to roll over money to a qualified family member. And the definition of a qualified family member is the original student's mom, dad, sister, brother, aunt, uncle, niece, nephew, a child, or first cousin of theirs, and that includes all steps, calves, and in-laws. So yes, you can definitely open up one account and put in as much as you can, and then later divide it up, because the person who is enrolled at the school has to match the person whose name is on the account. So eventually you would have an account for each child, but yes, you can get started with one. So who can open up an account? Anyone in this room? You have to have a social security number or a tax ID. There are no income limitations, so a lot of times people say, oh, I make too much money. Not true with the 529 plan. No income limitations on the tax credit. You can open up an account for the same child can have multiple accounts. So I can open up one, the grandparent can open up one, an aunt can open up one. That's not a problem. The best thing is you retain control over the account. So your child, when they turn 18, can't say, I want to go and join the circus, give me my money. You don't have to turn over any money because it's your money. That's also a good thing for financial aid purposes because the money is treated as an asset of the parent, so it does not have as big of an impact on financial aid as if it was in the child's name. So it is your money. Anyone can be an account owner. You don't even have to be related to the person you open up the account for, so you don't have to be able to claim them on your taxes. So if you want to open up an account for my child, I would give you their information and you will get that. Who can be a beneficiary? Once again, anyone can be a beneficiary. So if your spouse is going back to school and you want to put some money away to pay for their books, maybe they get tuition reimbursement, but they're out of pocket for books, you can open one for your spouse. And once again, you can change the beneficiary to a qualifying family member as well.
Is it just one beneficiary?
One beneficiary per account, yes ma'am. So there will be one adult owner and then one future student on each account. You can name a successor account owner when you open up the account, and that's the person in the event that something happens to you, you want them to take over the account. So I always tell people, don't name your favorite auntie or cousin, name the person who's most responsible with money. The long-standing joke in my family, when I die, my best friend gets my money and my mom gets the kids, you know. And my attorney was like, that may be an issue, you know, does your mom know this? And I call my mom on speakerphone, I'm like, Mom, what happens to my money? She's like, Karma gets the money, I get the kids. Everybody knows, you know, tell people what's going to happen, so there are no surprises there. I love my mom, she can have my kids, but she cannot balance the checkbook to save her life. So. What happens if the beneficiary doesn't go to college? Probably our second most popular question. I always say I'm going to just take my kids out and shoot them. You know, my kids are 7 and 9 and they sit right here in the front sometimes when I'm doing presentations and they're like, Mom. But I've convinced my kids that college is a requirement. My daughter came home and she goes, Mom, I figured it out. I have like 10 more years left of school. And I said, really? Did you have those 4 years of college? And she goes, no. Are those required? I said, yes. Yes. So my kids are convinced that, you know, college is a requirement. But what happens, honestly, if for some reason your child doesn't go to college? They can be a late bloomer. Some of us are still figuring out what we want to do when we grow up. So there's no expiration date on the funds. You can leave it in there. So if your kid's 23, 24, 25, and they're like, oh, I got it now. I know what I want to go to school for. You can use the money for them. You can also change the beneficiary. So we talked about that definition before. You can give it to your niece or your nephew or another child or aunt or uncle. So you can definitely move the money within the family. The last option is you're going to take the money out. So it's not like your flexible spending account where if you don't spend it, you lose it. You can take this money out, but there are going to be taxes and penalties on it. So the only way that they'll waive the 10% penalty is for death, disability, attendance at a military academy, and scholarship. So I have a lot of people jump up and down and say, oh, my kid's getting a 4-year scholarship. You're probably still going to use the money in your 529 plan. One of my coworkers was a financial aid administrator for 18 years. She has never met a family that saved too much money for college. I mean, it's sort of kind of hard to do with the way college costs are going up and up and up every single year. So if they get a scholarship, what if they change their major? You know, your scholarship only pays for 120 hours. How many of you graduated with like 140, 147, you know, like I did, because you changed your major? So you could probably still use the money in your 529 account. So it's not something that you put the money away and you'll never see it again. I heard some of you talking when I first came in about some of the other programs that we have, and we have one program called U-Gift, and with this program you can tell your family and friends, instead of making a contribution or buying my kid a toy they don't need, you can make a contribution to their 529 account. So if any of you have teenagers, you know there's hardly anything they want that's 20 bucks. You know, everything is more. So instead of giving them a gift that they don't want, just put it in their account, help pay for books. You can use it for any event that you want. And it's sort of like a little e-bite. It sends an email to family and friends, and they can go online and make a donation. Or if they prefer to mail in a check, they can print out a little barcode and mail in a check as well. We also have a program called U-Promise. U-Promise is our sister company. They celebrated their 10-year anniversary last year. Joining U-Promise is free, but it helps you get free money back from participating providers when you shop with them. For example, whenever I go to McDonald's, I use the little Arch card. If you've ever gotten a McDonald's gift card, if you look on the back of it, it has the U-Promise logo on it. Every time you reload that Arch card, you get money into your U-Promise account. So instead of paying cash, you pay with your Arch card. Participate in grocery stores like Marsh, Kroger, CVS Pharmacy, which I saw here in town. You just register your little key tags, and when you buy participating products like Florida's Natural Orange Juice, for example, you get a percentage back from those companies. Spring break, people are making spring break plans. Travelocity, Expedia, Budget, Avis, Marriott, Sheraton, Southwest Vacations, all of those are participating companies where you can get free money back for your kids' college education. We do offer a credit card with the U-Promise logo on it. It's not required. I have mine linked to my debit card, and so I still get the percentages back, you know, from the merchant. So it's a fun way. If you're going to make these purchases anyway, you might as well get something back. We're not encouraging people to go into debt. We were started with the premise of people can save this money and use it to either pay down existing debt, because you can use your U-Promise money to pay down a student loan. You can use it to fund a 529 plan. So anything to help you that's college related. This is just the sample U-Promise account. You can see a McDonald's Arch Card transaction, QVC, eBay, ExxonMobil, 123 Inkjet. So lots of different retailers that you can use, probably one that you shop at already on a regular basis. What questions do you have on the 529 plan, on U-Promise, or U-Gift that I can answer for you now?
What kind of administrative fees are we seeing?
Excuse me. So the fee that you will see is that asset-based management fee. That's 0.29 to 0.93%, and it's also highlighted in the brochure that I gave you. It depends on which investment option you select. But there are no other fees associated with our accounts. For example, you change the beneficiary, we're not charging you $25. You roll your account over to someone else, we're not charging you $15. The only additional thing that you will be charged for is if you need a check expedited. So you need us to UPS a check, we're going to pass on that $15 UPS fee. Speaking of checks, let's say that you have a student and it's time for them to go to school. How do you get the money out of your account? You simply give us a call, or you go online and request a withdrawal. You don't have to send any receipts to us, but you do need to keep them in the event that you're audited by the IRS. You can have the money sent directly to the school, directly to the student, or directly to yourself to reimburse yourself for expenses that you've incurred. So it's very easy to get the money out of the account. Other questions? Yes, ma'am.
Go ahead. Because you mentioned like you can use it to pay off student loans.
Your U-Promise account. So U-Promise can be used to pay down student loans, or it can be used to roll over to your 529 plan. Okay. So the U-Promise is the free money you get from shopping. Mm-hmm. The 529 plan, on the other hand, can only be used for future expenses. So if you just wrapped up school in December, you can't use your 529 plan to pay December bills, with money you're just now putting in.
Answered it myself, thanks.
Oh, okay. And I have a booklet here, and you can also look on the internet and get a breakdown of the different fees if there's one in particular that you're looking at. So I do have a couple of these. What other questions do you have? The 10% penalty. So the 10% penalty is charged. So let's say that for some reason you need to pull $5,000 out of your account. And I'm just making these numbers up. $4,000 is the money that you put into the account yourself. $1,000 are the earnings in the account. The 10% penalty applies to the earnings in the account. So your earnings are going to have a 10% penalty, and you're going to pay regular taxes on it. And that's exactly what happens when you pull money out of a 401k early. You're taxed on those earnings because they were tax-free, and then you're taxed a 10% penalty. So that's what's going to happen there. The third thing that will happen is your state income tax credit. The state may come back to you and say, we want our state income tax credit back. Because we all hear about the budget crunches, and they don't want people sticking money in a 529 plan just to get that $1,000 credit. And their beneficiary is 47, and they have no desire to send them to school. They just want the tax credit. So that is in place to keep people from abusing the plan. I could say we've done audits, here, and that's really not the case in Indiana. But we definitely don't want a few people to ruin it, for everyone. So that's worst case scenario if you pull the money out for anything other than education.
So how does Indiana's plan rate among the other state plans that are available?
There is, it depends on which source you look at. You can look at Morningstar, you can look for savingforcollege.com. And it depends because each plan is different. Each plan has different things that makes it unique, so you cannot compare apples to apples with the plan. And so that's one thing that you'll see as commentators say, we graded them on this, and this is our rating. So I'll tell you in form of the tax credit, Indiana is one of the few states that has a tax credit, and they are the only one that has a 20% tax credit. So you're not going to see in other states, the advantage of putting into their 529 plan isn't going to be as great as Indiana's. So I would say Indiana definitely has, if not the best, one of the best tax advantages for investing in a 529 plan. If I look at my neighbor, Kentucky, Kentucky does not have a tax advantage for investing in their 529 plan. Missouri, they have an $8,000 deduction, and that sounds like a lot, but it's deducted from your adjusted gross income, and their tax rate is 6%, so you put in $8,000, you're going to get $480 off your taxes, versus Indiana put in $5,000 and you get $1,000. So it's a huge difference. So I would say number one in terms of tax advantages, and then we have very solid investment options, especially because we utilize Vanguard, and they're one of the oldest no little fund families in the country. They have over $1 trillion in assets under management. So they're known for value and low cost. So we have some very solid performers within our 529 plan. And you can also click on our website and pull up the 1 year and the 3 year performance for our plan. We took over the plan from the previous administrator in the fall of 2008. We took the plan over and we introduced lower fees and more investment options.
I saw some state ratings and Indiana wasn't even on the list.
Well, so that goes back to if you were required to have like a 5 year, we haven't had the plan for 5 years, so our investment performance wouldn't go back for 5 years. So they may not have had data to rank. So it goes back to what you're looking for and who's doing the rating.
What about divorced families? Does each parent open their own account, or can you open an account that both parties are contributing to?
I'd open my own plan because I can go in and pull that money out, and who's going to get the tax benefit? The account's in my name. I file my taxes first. Of course, yeah, we're supposed to. You take yours. I'm supposed to take mine. But I definitely open up 2 accounts. Plus, we're only going to be able to talk to one person when they call in, and that's the person who's on the account.
So if multiple people on that account, it's not like a joint checking.
Multiple people cannot be on the account, but multiple people can have an account for the same child.
Okay.
So mom can open one, and that's independent of yours, except for the total of your account cannot exceed $298,000. So we'll run beneficiary social security number and make sure together between you and mom you don't exceed that number.
On the U gifts, are there advantages to the givers? So grandma wants to put $500, does she get?
She gets the tax credit. You need to give her the account number, and she puts the account number. So if you've done your taxes and you use TurboTax or some other software, there's a question on there that says, what are your contributions to the College Choice account? You just put your account number on there, you put your dollar amount, it calculates a 20% refund. So grandparents who normally give savings bonds may want to look at the 529 plan because they get that 20% tax credit. Maybe they already own their home, so they're not getting those tax advantages, but this is definitely one that they can use.
So they would have to open their own account though?
They would not. They can put
they
into
just-
yours. You just have to share your account number, not your statement, just your account number. Well, if there are not any other questions, I'll stop here. I do have some bags, some pins. I know this isn't Coke country, but if you are a Colts fan, you're welcome to take another magnet. And then I have some perpetual calendars for your desk as well. So if you like any of those goodies, feel free to take one. And then I'll be here if you have any questions as well. There's an email address that's in your brochure. On the back, it says indianaemployer@upromise.com next to the teddy bear. That actually comes directly to my inbox, so it doesn't go to a call center. It comes directly to my inbox. So if you have any questions, you can reach me there. Thank you very much for your time.
Thank you.
And also, before everyone leaves, and since we have Jeff in the room, I might slightly put him on the spot. Since we are kind of on the subject of tax credits, I thought it would be appropriate just to remind everybody that we do have the IDA tax credits available, where if you donate money to our IDA or individual development accounts, you actually get a tax credit. Now, you can't get it on the taxes you're filing right now, but you could get one for next year. So we've got brochures out on that as well.